What is going on, guys? Nick here, back with another video. Last week was the return of the annual capitalist Woodstock convention known as the Berkshire Hathaway Annual Shareholder Meeting. And now we know that a lot of people so far in 2022 have been saying that the market is really disappointing and that it's an awful time to invest. However, that hasn't stopped a 91-year-old Nebraska man from going on a massive spending spree. In fact, just over the last quarter, Buffett spent about $40 billion of the enormous pile of cash that Berkshire has been sitting on. And compared with what Buffett said just a few months ago in the annual shareholder letter, that he was having a hard time finding stocks that met their long-term holding criteria, this is a pretty big change. Now, most of the attention from the shareholder meeting has been about Buffett saying that he wouldn't buy all of the Bitcoin in the world for $25 each if you offered it to him, and that the stock market has turned into a gambling parlor. And the biggest move out of this $40 billion purchase has hardly even been mentioned at all. In fact, during the meeting, Warren and Charlie didn't even mention the purchase. Now, this chart comes from Berkshire Hathaway's 2021 annual report. These are their biggest stock holdings as of December 31st, 2021. Their ninth largest position on this chart is Chevron, which is made up of 38 million shares and at market price was worth $4.4 billion. Just 3 months later, Berkshire put out their first quarter filing. In this very teeny tiny footnote, Berkshire just kind of threw out there, oh yeah, our four largest stock positions are American Express, Apple, Bank of America, oh, and Chevron. And this Chevron position is now worth $26 billion in market value. Wait, what? If you do the math based on the share price December 31st to March 31st, that means they increased their share count from 38 million shares to 165 million shares in just 3 months, and nobody is talking about it. In fact, some people are even completely writing it off.
Can hardly think of a more useful oil industry. Tell me you're a 98-year-old stooge with no stake in the future of the planet without telling.
And then multiple other posts where this isn't even mentioned. Most people seem to be looking at oil and gas like an old man type of investment. And that is probably fair when you look at Chevron's returns versus the S&P 500. A $10,000 investment in Chevron made in 2009 would have increased by 138%, including dividends, while the S&P 500 over the same time span increased by 257%. And then with all of the pressure to stop using oil and save the environment, record investment in renewable energy, and electric cars actually becoming a really normal thing to see on the road, it seems like the glory days of oil are probably in the rearview mirror, and I do totally get why people are overlooking this purchase. But the past 2 years have completely changed the oil industry. This chart shows the world's oil production compared with the world's oil consumption, the literal supply and demand chart. Between 2017 and the first quarter of 2020, we saw a very slight rise in demand for oil, which was matched pretty well with the production. But then in April 2020, crude future prices actually went negative, and oil producers having nowhere to offload all of this oil had no choice but to shut down production. This came at the end of a time period when shale oil production was at its peak, and the oil industry as a whole was fighting razor-thin profit margins. Taking a look at Chevron's revenue and net income, we can see how profits were very, very tight between 2015 and 2019. And when oil demand collapsed, things got even tougher. The actual price of crude dropped to just $30 a barrel by the end of the first quarter of 2020, just half of what you would have paid 3 months earlier. But of course, demand wouldn't stay this low for long, and we saw very slowly a rebound in oil consumption. Mike Wirth, the CEO of Chevron, said at the end of 2021 that we're an even stronger company today than we were just a few years ago. Interesting. They talk about the growing dividend, strengthening the balance sheet, reinvesting to grow future cash flows, and then additionally they point out that they've invested in oil and gas and new energy opportunities with discipline. With discipline is the biggest key to Chevron, oil, and Buffett's entire bet. When we go back to this chart looking at consumption versus production, we can see that pre-2020 consumption and production would just kind of bounce higher and lower of each other, nothing really that consistent. But since the 2020 rebound, we see a huge change, that production has increased with consumption, but at a consistently slower rate. And this consistent lag in supply increase versus demand increase has made a world of difference for oil and gas companies. Generally, when there are massive surges in prices, the theory is that businesses will come in and compete with each other to produce more. And this increased supply will drive down the overall cost of the product, which of course cuts the profit margins of the companies producing the product. At least that's how it's supposed to work. But oil companies haven't come rushing in to boost supply, and from the looks of things, it doesn't seem like they're in a hurry to do this at all. This chart shows oil drilling activity versus oil prices. As oil prices dropped in the beginning of 2020, unsurprisingly, so did oil drilling. But while the price of oil has come back up relatively quickly, drilling has not. By July 2021, oil drilling was still 42% lower than July of 2019. Oil companies know that the world is trying to make their business obsolete. And with the rise of electric cars and renewables, it does seem like we're on pace for a big chunk of their demand to disappear over the next few decades. But by keeping supply just behind demand, oil prices remain relatively high, which leads to more profitable sales. And for oil companies, this has led to some of the best conditions that they've seen since the early 2010s, which means that contrary to what a lot of people perceive about the oil industry, putting the environmental concerns aside, from an investor standpoint, now is a great time to be an oil company. Chevron just announced they would be taking one of Warren Buffett's favorite actions, which is a share buyback program where they would purchase between $5 to $10 billion of its shares per year, and that as long as oil remains above $50 a barrel, that it would be very sustainable for them to do this. That means that Chevron is going to be buying back somewhere between 1.5% to 3% of its shares every single year, adding to the value of the shares owned by investors right now. Now, when we look at Chevron's financials, the past 10 years show revenue and profits are pretty all over the place. It was generally profitable, but not always very consistently. A lot of this had to do with the rise of shale production, like I talked about earlier, between 2014 and 2016, which drove the price of oil down. When I overlay the price of oil, we can see just how impactful crude pricing fluctuations have been on their bottom line. And with those prices projected to be higher for some time, this is a big benefit to Chevron's business. The past year has seen $176 billion in revenue and $20 billion in profits, which are their highest profits for them since 2013. Now, when we look at the revenue versus expenses, there's actually a lot changing with this business. We can see just how widely their depreciation expenses have changed since 2019. The actual expenses have dropped by about $10 billion during this year. It's a little harder to see on this chart, but the operating expenses also remained exactly the same, while they have continued to increase their revenue over this time period. Now, when we look at their business segments, Chevron has two major segments: upstream and downstream. Upstream revenue is produced by discovery, extraction, and production, and downstream revenue is produced by refining and delivering the oil products to customers. What is pretty clear is the upstream business is far more profitable than the downstream business. It also looks like the international segment was doing much better. However, I went back a few years and the upstream US segment was producing about $3 billion in profits per year before that, so it is actually a lot better than it seems on this chart. Now, when we look back at the current forecast for Chevron, the big surge in profits we've seen over the past year is expected to relax a little bit. However, the current forecasts show a much better atmosphere than what Chevron experienced between 2015 and 2020. They're projected to earn about $185 billion in revenue and $24 billion in profits by 2024. Now, Chevron also pays a pretty healthy dividend, with the past year yielding about $5.44 per share, which at today's price is about a 3% yield. And when we look at the forecasted earnings, there is a lot of room for that dividend to grow going forward. Now, if we value Chevron with a growth rate between 3% for the bottom end, that puts the fair PE value around 10, and at a 6% growth rate going forward, that puts their fair PE value around 14. Now, by 2024, this does look like the stock is pretty expensive, but my guess is that since there's only 2 analysts for this year, Buffett has just a much more optimistic projection for where this company's earnings per share will go by this time. We also don't know exactly what Buffett paid per share yet, and because the share price went from $120 to $170 during this quarter, he probably got a much better deal than today's price. If he got in around $150 per share, it seems like he may have gotten a very good price for that large amount of cash. Plus, it's going to keep paying a very healthy dividend going forward. Now, keep in mind that when you have $140 billion to invest, the rules around investing that much money are a little different. What this does say to me is that the oil industry does get a very good vote of confidence from Warren Buffett that he expects that the market conditions will be much better than the razor-thin profit margins that they had experienced over the past decade. Oil producers definitely seem to be very in control of their market right now. And even if it is true that oil demand will decline over the next couple of decades, I think it might be a much softer landing than a lot of people had expected. Now, this video up here next shows you why to get inflation under control, things are going to have to be a little bit painful by taking a look at the last time the US faced an inflation crisis. And as always, thanks for watching.